Gold may not be something you use to pay for groceries today or see changing hands in everyday transactions, but that doesn't mean it has lost its value. It's not because gold became worthless, but because governments have put up barriers that keep it out of circulation. Yet despite that, gold still holds all the timeless qualities that made it humanity's top choice for money throughout history. In times of economic trouble or rising inflation, gold has always been a trusted asset. It doesn't correlate with other investments, making it a great tool for diversification. And lately, gold has been hitting an all-time high of $3,500 per ounce, so that kind of performance might make you feel like you're missing out. But before you jump on the bullion bandwagon, it's important to understand what's really driving the surge. Gold may be hitting record levels, but investing in the market may still be the better option. Stocks have averaged an annual return of around 10%, and over the past decade, its total returns have far outpaced simply holding gold. Gold is often described as an inflation hedge, but it hasn't lived up to the hype either. A true inflation hedge should rise when inflation rises, but that's not what gold reliably does. In fact, historical data shows a mixed track record during inflationary periods. From 1980 to 1984, inflation was 6.5%, yet gold delivered a negative 10% return. From 1988 to 1991, inflation ran around 4.6%, and gold fell another 7.6%. Only in the 1970s, when inflation surged to nearly 9%, did gold shine, returning a whopping 35%. But overall, gold's correlation to inflation over the past 50 years is just 0.16. That means investors worried about inflation are taking a gamble by relying on gold as a hedge in their portfolio. Meanwhile, productive assets like growing businesses keep generating income. Geopolitical tensions are rising, especially with the ongoing trade war between the US and China. Central banks in emerging markets have significantly increased their gold reserves. In addition, persistent inflation has led investors to seek assets that protect against rising prices. On top of that, the US dollar has weakened, further increasing global demand for gold among investors looking for something steady, an asset that can hold its value during these uncertain times. All these demand drivers might encourage you to invest in gold, but it's worth listening to the voices of successful investors, like Warren Buffett, who has been critical of gold for years. Let's take a look at what he has to say about this precious metal. According to Warren Buffett, gold is a way of going bullish on fear. People who buy gold are essentially betting on fear. That's their motivation. You're basically hoping that people will be even more afraid a year from now than they are today. If fear rises, you profit. But if fear fades, you lose. That's a strange kind of investment strategy, one that depends on emotion. It's true that, just like today, this bet has held over the past decade. Fear does, and still does, drive demand for gold. That's exactly why it's often seen as a safe haven investment, something people flock to in times of turmoil to feel more secure and to balance out other areas of their portfolios. But here's the thing. While gold may help you feel safer, what you really want is an asset that produces. Something that builds real value and helps grow your wealth over time. Trading gold can be profitable, but gold is a poor investment because it doesn't generate returns or contribute to productivity. That said, some traders do profit by speculating on price movements during active markets. In those moments, gold can be a great trade, but in most markets, it does little or nothing at all. Value investors prefer investing in income-generating businesses that create value through real products and services. As Warren Buffett said, "It's a lot better to have a goose that keeps laying eggs than a goose that just sits there and eats insurance and storage and a few things like that." Now, gold is expensive to own and handle. It has a volatile price history and a weak track record as a hedge. Instead, investing in wonderful, undervalued companies with strong fundamentals and durable competitive advantages can deliver far greater long-term value. Warren Buffett's powerful philosophy of investing centers on buying wonderful businesses at fair prices. It involves the pursuit of high-quality companies with durable competitive advantages, what he calls economic moats. These are businesses that can maintain pricing power, a strong brand identity, or cost advantages that protect them from competitors, making them resilient and built to last. According to him, we should focus on companies that are easy to understand, with predictable and consistent earnings, placing strong emphasis on free cash flow and steady performance. What matters is not just how much a company profits, but how well its leadership allocates that capital and whether they treat investors as true partners. Patience and discipline shape his entire approach. He doesn't try to predict recessions, time the market, or bet on fear like in the case of trading gold. Instead, he stays rational and waits for the right moment when prices fall far below intrinsic value or the true value of the company. His mindset is simple. Be fearful when others are greedy, and greedy when others are fearful. And unlike gold, which relies on emotion and speculation, Buffett seeks the margin of safety, the gap between what something is truly worth and what it's selling for. Thank you for watching. If you liked this video, please give it a thumbs up. It really helps and keeps me motivated. You can also leave a comment to let me know what topic you'd like to see next. I'm here to share investing tips and advice to help you on your journey.